Okay, bingo. We are recording. Welcome, everyone. We're talking about RRSPs today with Mr. Trevor Lindey about how to self-direct your RRSPs, what kind of options are available once you have self-directed your RRSP or your Lira accounts, talking about all those different accounts and what they mean, some of the options available for investing in mortgages or second mortgages and other types of investments that Trevor here is familiar with. And let's introduce Trevor. Trevor Lindey, is that correct?
Yep, you said it right.
So Trevor Lindey is a mortgage broker with which brokerage?
Neighborhood Dominion Lending Centers.
Okay, perfect. Out of?
I'm based out of St. Catharines. Our head office is out of Newmarket, and pretty sure our numbers are about 75 agents all across Ontario.
Okay, perfect. And then you do handle and as a mortgage broker get mortgages for people. I think everybody knows what a mortgage broker does, but in your investments, you're actively using your own capital to lend out and structure different investments that way with mortgages, correct?
Yeah, essentially with all the regulatory changes that have happened over the last number of years with the government, Bank of Canada, so OSFI, the Office of the Superintendent of Financial Institutions, they've really made lending requirements for individual borrowers a lot stricter, and it basically opened up the opportunity for a lot more people needing to invest, needing to borrow money privately, whether it be short-term or long-term, all depending if it's, somebody going through a separation, doesn't have a separation agreement in place yet. It's kind of hard to facilitate financing for them in normal means. Somebody's looking at doing a flip. Lots of people like to talk flips. The reality is financial institutions don't like investing or doing mortgages on flip properties. So that's where private money can come in. Mm-hmm. And then depending on what type of investment that you have. So whether it be, non-registered investments registered via TFSA or RRSP, you can potentially lend your money out as well for construction financing. So a lot of people that are newer developers getting out into the market need capital, right? They have capital. I shouldn't say it like that. They've got their resources available to them, but they don't have the ability to secure the full 100% of their construction cost. So that's really where they kind of lend on brokers and going to mix to be so mix. Sorry, I'll use a lot of acronyms, not intentionally. So I will try and explain all of them. But a MIC is a mortgage investment corporation. So it's basically the ability for a bunch of people theoretically to pool their money with a company. So send that money to the company. The company can then lend that money out on their behalf. It is different than a syndicated mortgage. Our brokerage doesn't do syndicated mortgages. There's too much red tape associated.
Nobody does.
No, you know what? Like my last brokerage that I was part of, we did allow syndicated mortgages. We were allowed to do them, but again, regulatory body, the FSRA, which is our licensing body as brokers and agents, it's just the red tape and the possible trouble that we can land in and litigation and such, just it isn't worth it. So brokerages are getting away from syndicated mortgages.
Yeah, I quick story on syndicated mortgages. So I don't know if I don't want to get into the whole, it would take us an hour to explain everything, but I'm pretty aware of what happened with Paramount and Fortress and some of those guys. But let's just say the fallout from syndicated mortgages with the sort of collapsing of Fortress and Paramount and their structures was that not a lot of the lenders, the big lenders who are lending on larger construction projects for development, are not gonna take the syndicated mortgages anymore into consideration. And there was a number of, I shouldn't say a number of, but a handful of projects that I was aware of where the money was raised through syndication, and when they went to, and then the whole syndicated pyramid kind of came down, and when they went for their construction loan, the bank said, get rid of your syndication, then we'll give you the construction loan. And that's basically like, gun to the head kind of thing. And that might be, I just wanted to say that to plant a seed with everyone, because the whole syndicated mortgages thing, that's an entire QnA subject altogether.
Yes.
So please understand that. And I don't mean to throw that at you and then not talk about it, but I maybe we'll bring Trevor back and talk about that, because it's a completely different subject. Now,
yeah, and if there's enough people that would be interested, we can definitely do that.
Yeah, I think I'd be interested. I'd be interested, for God's sake. And I think once we record it and get it out there, people love to listen to. They listen to these. I record these and then send them out afterward to the database, and then people listen to them like podcasts, like crazy.
Yeah,
So
nice.
it's fantastic. And then, so what I wanted to do today is take someone through like the way you would look at a client and give them some advice. So we'll use me as an example. So if people don't know this, and most of you won't, is I used to be, I bought my first property when I was 24. I just turned 35 last week. So 10 years or so I've been investing. And back then I was just getting hired on the fire department. So I was a fireman in Toronto Fire, and I did that for a long time. And then for 10 years. And at the same time as I was getting hired in the fire department, I started working as a realtor at Rockstar Real Estate and helping other investors, buy rental properties like me. And throughout that entire time, I was, acquiring investment properties myself and with my partners. And, we've accumulated a pretty sizable portfolio. And last year it came to a point where I couldn't handle everything that I was doing, having a family with 3 kids, being a fireman, helping all these investors buy and sell their apartment buildings and duplexes and student rentals and all that kind of stuff, plus manage my own portfolio. And I made the tough decision to retire from the fire department after about 10 years. So that was a scary thing, if you can imagine, but that happened. Now, why this is such an important conversation with me with the self-directed RRSP thing is, as a fireman, a teacher, the police, they have OMERS pensions. So now that I'm retired, I had to do something with the money that was in my OMERS defined pension. So I said to OMERS, hey, I don't want you keeping the money because I don't trust you. I want to move that money into a self-directed account, which they're going to, a CRA and OMERS will allow me to do. Some of it has to go into a LIRA, a locked-in
retirement account.
A locked-in retirement account, which is basically the same as an RRSP, except that I can't pull money from it until I'm 65 or whatever. And the rest of it will go into an RRSP. So I'm literally moving, several $100,000 into these self-directed accounts right now with Olympia. And now I'm looking to people like Trevor to help me decide on what the best course of action is. Do I do second mortgages, lend on construction, and what's the deal? So pretend I'm your client and you're talking to me and you're giving me advice. What's the story here? What would you be doing?
So I guess from, somebody's coming to me first, we're having the initial conversation about, hey, I've got this money, I'm looking at investing. First, it involves, having your money in the right, with the right company. So you've got a couple of options so there's 2 types of mortgages. There's non-arm's length mortgages. So it sounds kind of funny when you think about it, but non-arm's length means they're a relative of yours. They're connected in some way through marriage or blood. Then there is arm's length transactions, which is anybody else. As long as you don't know them, you can lend them money. So we've got to be able to move the money into 2 different institutions. There's Olympia Trust that Paul's already mentioned. The other one is CWT, Canadian Western Trust. There's a lot of similarities about the 2, and then there's some differences as well. The biggest difference for Canadian Western Trust, I've kind of always leaned on them. I just find them to be a little bit easier, but there's a lot of people that have had great experiences with Olympia as well. But a big differentiator between Olympia versus CWT is Olympia will only allow arm's length transactions. They do not allow non-arm's length, whereas with CWT, there is the option of doing non-arm's length transactions for family members. There is some pretty strict lending requirements involved in it, but it is an option. It is something that's available there on purchases.
I remember you explaining that to me, and I'm thinking, wow, that's a good option. And then I'm thinking, man, when do I ever want to lend money to my own family? Never. So I'm like, screw it. I'm going with Olympia.
Yeah, again, everybody's in a different
Yeah.
circumstance. Like if you've got an immediate family member that, let's say they're in the construction trade,
Mm-hmm.
right? They're in the construction trade. They're looking at flipping houses. And they have been doing it for a while. Then, hey, maybe that is an option, right? I cautiously say flipping houses, not tearing down houses, because for all intents and purposes, on a non-arm's length transaction, construction mortgages are not allowed. So you wouldn't be able to do like a full-on tear down, but a full gut job is a different story.
Yep.
So okay, so that's basically the first part of it, kind of assessing and a matter of moving your money to those institutions. They do have the ability, whether it be a LIRA or RSPs or tax-free savings account, you can invest through them. Non-registered investments really aren't necessary to move because, let's say you've got them sitting in mutual funds at TD, Scotia, RBC, you can just pull that money out and lend it as cash, get a bank draft. So what happens with private mortgages is you will have legal counsel. So you will have a lawyer I'll take a step back. So the Law Society of Upper Canada requires separate legal counsel when you are doing a mortgage greater than $30,000. So unless you're doing a second private under 30,000 or less, you are most likely going to be hiring your own legal counsel to be able to draft up your mortgage instructions on your behalf, put all that paperwork, do the legals to make sure that you have proper security of the subject property that you're lending your money on. Those costs are the borrower's responsibility. So these aren't your legal fees aren't going to be your cost that you're going to be incurring to complete the transaction. So that's usually a question that people come with and ask about. Typical rates of return is always on everybody's top of mind. Right now, first mortgages, you're looking at anywhere from about 7 to 9%. Sometimes it's plus fees. Sometimes that's inclusive of fees. So what that means is typically, so a big thing to note is, as I mentioned at the start of this, that a lot of people are, because of the regulatory changes, they're getting involved in private mortgages. They need to go that route of a private lender. And what we found is there's been a weeding out process. A lot of investors that are acting greedy, a little too aggressive, specifically, on lender fees that they might be charging, which typically a lender fee is with Olympia Trust or with CWT. You can go to their websites. They have their full fee schedule available there that you can go and look through. And the whole idea in charging a lender fee is obviously to help cover those costs, right? So because you as the investor, are trying to mitigate the amount of expenditure you have. So you're maximizing and theoretically making your net return, so your gross return of 7 to 9%, your net return of 7 to 9% on those first mortgages. But to continue on from that, what I've found is there's been a big weeding out process for a lot of people that are or have been really aggressive, a little greedy in their asks. So, maybe asking for like a 4% lender fee. It's a lot harder as a broker to be selling that to somebody. And realistically, there's enough people out there that they know that, there's other options. So it's almost, if you're overcharging, it becomes the preying on the weak, and those die out pretty quick. There's not a lot of people that are surviving in that space. Beyond that, second mortgages. So second mortgages are going to there's a lot more risk associated with those second mortgages, right? Because you're going behind another lender, another financial institution, whether it be a chartered bank, credit union, or what have you. So from a risk perspective, you've got to be very mindful of that there's no guarantees with anything. Like, yes, these are the interest rates that you can be charging on mortgages, but so that everybody realizes, in the event of default, when you're first, obviously you'd have to go through power of sale proceedings, your counsel would help you doing those sort of things to recover your money, or in turn recover the property if there's no way to recover the money. And then in effect, you would sell the property after. But when you're in second position, and why that's more risky is now as the investor, you have to either, if they're in default of your mortgage, you now have to be mindful of the first, right? So you can try and force power of sale proceedings on an individual when you're in second position, but you still have the first to deal with. Possibly if you're in second position and first mortgage is the one that goes in default, if you don't follow suit along with them and are notified and going through the process, it could potentially jeopardize your capital and your hard-earned money that you have invested in the project. So it honestly comes down to assessing risk. I always say to people, a lot of people think my business is solely about money, whether it's, private mortgages, purchases, refinance transactions, A lenders, B lenders, doesn't matter. But the truth of it is my business is solely based, it's risk. Money, the monetary, portion of it is the byproduct of assessing the risk. So when you're looking at it as a private investor, and kind of why I put, one of those key benefits being, the ability to turn your money a little bit faster is, do you want to be, stuck with a mortgage for an individual that is, you're going to be 25 years before you're ever going to get your money back? Well, that's not the ideal strategy as an investor, nor should it be the ideal strategy as the borrower. So working with, the right broker, or, theoretically number of brokers, or even getting associated with a MIC, Mortgage Investment Corporation, is a great way to go, because they can keep your money more active, and in turn being very mindful and, of the process for somebody getting involved. We always look at the exit strategy. That's a really big thing that as a broker, when I'm presenting a file to a private investor, they want to know, or if they're new to this and don't really know what questions to ask, is what's the exit strategy? So is this person, they've lost their job, financial hardship, they've contacted a realtor. So, maybe they've called Paul in and said, hey, you know what, got to sell a place. And Paul says, geez, you know what, this house is really run down. If you could come up with, about $30,000 in renos, you can really maximize your rate of return, right? Maybe he's saying, I'll use myself as an example. A number of years ago now, realtor came into a place. It was quite badly damaged by former tenants of mine, and said, okay, well, we can list for 250, but you know what, if you put about 15, 20 grand into it, now all of a sudden your return's going to be, we can be asking 300,000. So let's say that's the circumstance, and that person now needs money to fix it up. So the exit strategy is they're going to be selling it. Or, maybe the individual is, they've had credit trouble in the past, and, they've been working on it, but they don't have enough time under their belt to be able to go with a B lender or an A lender. That's the exit strategy in that case. And, working with the right individuals to make sure that they're going to work with that person to be able to move them from a private lender to a B lender to an A lender. Maybe the individual is self-employed, and having the conversation of, you know what, Mr. and Mrs. Client, you really need to start showing some more income on paper. We can see that it's there, and there's the other exit strategy. Or another thing that I had alluded to before is the separation agreement. I've got that on the go right now, where, I've got a client, there's no separation agreement in place. So we're looking at alternative options. Does that make sense? Can we go that route? How long is it going to be before the separation agreement is drawn up? So key to that, again, sorry for the ramble, but it comes down to the exit strategy. So you as the investor really want to make sure that you understand the exit strategy so that you can recover your capital.
Okay, perfect. So let's run it through for someone. So I'm already moving my money into Olympia. Let's say somebody, I'm assuming people on the call here already have RRSPs or LIRAs or TFSAs that are self-directed. Maybe they have a bunch of mutual funds or non-performing types of investments. what's the process to liquidate that and move it to an Olympia or a CWT?
So there, you can visit both of their websites. And I don't know if it helps, like after the fact, we can probably send them out, or alternatively, yeah. So Canadian Western Trust is CWT.ca, and Olympia Trust being Olympia Trust. So OLYMPIATRUST.com. And basically from there, you'd be filling out an application. So you'd be doing a transfer application to move your funds from the current financial institution that they're with. The best way to put it is, if anybody on the call has had any experience transferring from one financial institution to another, the process really is seamless. There is no difference moving it to CWT or Olympia Trust. It's a seamless process where you'd fill out the application, you'd give them the account information, all those details. Now, keep in mind that anytime you're transferring any type of registered investment, so by transferring it as a registered investment, it is going to keep it in a registered investment. It's non-taxable for doing so. Whereas if you did an actual withdrawal from it, you'd be taxed and then reinvesting. So it doesn't make sense to be doing something like that. But as I said, a straight transfer from one financial institution to another. Keep in mind, you're very much at the mercy of the current financial institution that holds the investments. It's really on them to, do their job and transfer the money out. So very commonly, if it is sitting with, one of Canada's, big five banks, they might be trying to save the investments, right? They'll be calling you before they're going to just transfer it out to try and convince you to keep your money with them. So just be mindful of that. But, the process can happen rather quickly, something that, could take, I always try and tell clients, gauge 3 to 4 weeks. At least, like that's kind of at a minimum standard. I know I've had others where, again, because of some resistance from the institutions that have the money, have taken, 2-3 months almost to get the money moved over from their main institution over to Olympia Trust or CWT.
What's happening with me is, because I'm moving it from OMERS, I talked to my accountant first, and he told me to fill out a CRA form called a T1213 form, so a T1213 form, whatever it is. And basically, because it's moving from OMERS wanted to hold back tax at the source. And my accountant said, screw them, we're going to fill out this form. And so you can get all the money moved over, because it's all going into a registered account anyway. And if there's a tax burden, we'll deal with it next year, not them.
Yes. And as long as you're transferring in cash or in kind, it shouldn't, as long as it's not being withdrawn from the investment, there should be no tax implication for moving your funds.
Yeah, that's the same. Okay. So now let's say I got my money in Olympia, Lira, RRSP, whatever it is. And now I'm sort of deciding what's the best investment for me. So I can go into a first mortgage, into a second mortgage, into a MIC. What's the return difference and risk difference between, let's say, those three things? Or are those three things the most common types of mortgage investments?
The biggest thing that you first have to decide is, what is your risk tolerance? So just like when you sit down with a financial advisor, they go through a KYC, so a know your client. So you really need to assess, how comfortable you are investing in the mortgage space. So I would even encourage people, before you move your money to Olympia Trust or to Canadian Western Trust, to establish and determine, are mortgage investments a risk investment that you want to accept, that you're willing to accept, and if that is the case, then moving the money over. But as I said, partnering with brokers, or even, talking to MICs about some, investment opportunities to have the money to be able to be invested through them, and essentially establishing what type of mortgages you are most comfortable with. So, I have some people where they say, you know what, all I want to be doing is I want to be investing in flips or short term, anything that can recover my money within 6 to 12 months at a time. If that's the case, then though you already know that. Whereas, you know what, if you have a little bit more risk tolerance and you're willing to, be involved in second mortgages, then there's another opportunity. You open that up and you have the conversation with the broker or brokers and say, look, this is what my risk tolerance is. And now when we know that, we have the ability, okay, when we are presented with a file that is going to require private financing, I can turn around and say, based on Paul's risk tolerance, what he wants, he's willing to invest in first, seconds, some of his money he wants to be returned quickly. Some of it, he's okay having invested for, a couple of years, 2-3 year timeline instead. So that's going to open up his portfolio to be able to invest in more products and have a likelihood of, me reaching out and saying, hey, Paul, you know what, I've got this file, going to need, $250,000. This is the circumstances, and so on.
Well, would the timing of the investment or the loan, let's say, change the return also?
It can. Typically, as a private investor, most people don't want to be investing for longer than a 2-year time period because the investment horizon is too far out and to know what's going to happen in a couple of years. So what you can do is you'd have your agreements. So you'd have the contract basically drawn up stating that, here's the terms of the mortgage. Is it open? Is it closed? Obviously, it's going to be fixed rate. What contractual obligations are there? So because you're looking at registered money, they are required to make monthly payments that have to be contributed back into the RSP. So are you collecting interest only? Are you collecting principal and interest? Truthfully, most people collect interest only payments, because this way, if they invest $250,000 of capital and they're getting, $2,500 a month interest only payment, they know when the mortgage comes due, they're going to be paid out $250,000. So it's easier for them from we'll call it the accounting perspective, to just differentiate what's principal and what's interest in those cases. So what can happen, again, doing a 1-year term, open, closed, 3-month interest penalty, maybe if it's paid out prior to, let's say 6 months. These are typical clauses and conditions that we see on deals, and then, fully open thereafter, or some will say, no, it's closed, 3 months interest penalty to pay out at any point throughout the term. At the end of the terms become renegotiable. So just like any mortgage any of you have had dealings with over the years, same type of scenario where the mortgage comes up for renewal, and you have the ability to, renew or, demand note, call the money back in. So, assessing the situation. Well, hey, you know what? This person's always paid their mortgage payments, their interest only payments to me on time. There's never been any issues with that. So yeah, I'm okay doing another turn. And, maybe it's having a conversation with the broker, or thinking to yourself, you know what? Hey, I made 7% on this year, 7%. It's been good. It's performed well for me. Everything else in the market seems to be right around there, or maybe the market is up a little bit. You know what? Hey, I can get 9.5% from it now. But again, assessing the fees as well, right? Because obviously you're going to incur some cost to do that renewal, whether it be, just having your lawyer draft up new terms, and then just having it presented to the client, new contract signed. Maybe it's going to cost you $500 in legals. So you say to the client, you know what, 7%, 9.5%, what have you, $500 in legals, or, charging it however you so desire.
Yeah. My understanding is that if I'm borrowing $100,000 for a flip or a project or whatever it is, that I'm going to pay the lender's legal fees. So I'm going to pay, my 9%, I'm going to pay probably a broker fee of a 1%, a 2%, something like that. And then I'm going to pay his legal fees and my legal fees.
Yeah. So if you are the borrower, yes. So the borrower is always going to be responsible for any lender fees. the lender's legal fees and any broker fee associated with it. It's one of those, like, again, back to the whole cost. Like, there's some brokers out there that will really gouge on it. And there's others, like, honestly, myself, and I don't say this to toot my own horn, but I look at the situation and I find that in a lot of cases, somebody that's looking for private financing potentially is already down and out. They've already had some type of problem. So do I really need to go and gouge them and charge 2%, 3%, something of that nature? No. Realistically, when I'm doing a regular deal, I'm making about 1 point on it. So that's what I would be charging. But that, again, is not your cost as an investor. It's the borrower's cost.
Yeah, I find that's pretty common, 1 or 2% kind of thing.
Yeah.
Yeah. Okay. So I think that's enough questions directed or coming from my situation. I got lots of them. I could fill up a few hours here, but if anybody wants to unmute themselves, please feel free and maybe just introduce yourself and let Trevor know where you're coming from and what your question is. You're more than happy to do so. I'll give it a minute here to let someone kind of come on. Otherwise, I'll keep firing away. Don't be shy.
While we're waiting for the first shy person to, raise their hand, if anybody, would prefer dealing with a mortgage investment corporation, Neighborhood Dominion Lending Centers, the owners of NDLC, do have an in-house MIC, Bedrock. So I can always make that introduction if that was something that that anybody would be interested in.
Okay, I had a question come through the chat. Do you have a minimum amount to invest?
No,
if you have, okay, let me just rephrase for everyone. So I'm thinking, and that's Victoria, I think. Are you asking is there a minimum amount that you can invest if you're in an RRSP or self-directed? Like, does it have to be a minimum of 10,000 or 25,000? I think that's what you're trying to ask, Victoria.
It's hard, right? Like, obviously, the more money you have, the more available lending opportunities there are. It's not typical. Like I've been doing this for 12 and a half years. I've been brokering for, it'll be 5 years. Yeah, 5 years this October that I'll have been just brokering. I used to work for the banks and credit unions. I haven't done a deal for less than 30,000. So if somebody's sitting with, 5-10 grand that they want to, put into the market and invest using an arm's length mortgage investment strategy, it really isn't going to be worthwhile. And again, the more you do have available, the more opportunities it opens. So it opens you to, both first and seconds, whereas the smaller amounts, the 30, the 50, the 75s, those are really going to be, for the most part, only second mortgages that you're involved in.
Okay, I got a great question here. Can you please just, Trevor, explain the difference between a MIC and a syndicated mortgage?
Okay, so basically a MIC, as I mentioned, Neighborhood Dominion Lending Centers does have a MIC in-house, Bedrock, and they're a mortgage administrator. They basically have all the licensing requirements. They have been vetted. They are licensed through our licensing body to be able to lend money, administer money, and function as if they are a chartered bank, we'll essentially say. Whereas a syndicated mortgage is individual borrowers. So, like I'm looking here at the screen, I've got 5 across and 5 down. So I've got 25 sitting on my screen. Basically the 25 of us, all throwing in, let's say $10,000 each. Now we've got $250,000 there that we're working with. And that is a syndicated mortgage. So we have one lawyer basically representing us in the syndicate. But in the event that there's, basically financial hardship of the borrower, it is now on the 25 of us to all obtain independent legal counsel and on all of us to go and try and recover our money. We're 1/25th owners in a mortgage.
Okay. And
a lot more risk associated with syndicates. And like I said,
why is there more risk versus a syndicate versus and a MIC?
Licensing is a big thing. Syndicated mortgages people don't understand the disclosures associated with syndicated mortgages. Like, I'll give you an example. I personally, at the last brokerage, I invested in a syndicated mortgage. And as a syndicated mortgage, the disclosures that were required, the paperwork associated with it, my father-in-law was an investor. I was an investor. So everybody needed to have the full scope of that and full understanding, knowing that, like, I'm representing everybody. I'm not supposed to have a vested interest any one way or another, but you need to know that I do have, even though I'm trying to be unbiased, I have a vested interest as well. And you as a borrower as a lender need to understand that.
Mm-hmm. Yes. The vested interest part. I think that's where it all goes sideways sometimes.
Yeah. Right. Like, I gotta be honest. The reason I invested in a syndicate was because the borrowers are friends of mine and they were building a house.
Yeah.
I had 100% confidence going and investing my money in it. Like, I didn't have to worry about it. But, like Paul was alluding to, those couple of companies where there was some major issues, I wouldn't be investing and throwing my money willy-nilly unless I knew the person, right? I would rather go to a MIC that is licensed and their due diligence is second to none, right? They're looking out for themselves and they're looking out for you investing your money.
Yeah, we're gonna have to do a whole Q&A on syndicates, because if any of you understood what goes on and what goes on or what went on in the background with Paramount and the Fortress guys, your stomach might turn, knowing your money was invested.
Hi, Paul, Trevor. This is Jerry. I have a quick question for you.
Yeah, go for it.
Well, you're set up and say you're underway, you're earning interest. Is there a way, or do the banks, I guess, how do I put this? How do they see that money that you're earning? Like, can that help you qualify as income for future mortgages? Do you know what I mean? Based on the money that you're earning from your lent money?
As a non-registered investment, Jerry, yes. So if you have a non-registered investment that you're lending out and you can demonstrate a couple of years history return on that money coming in, then yes, that is entirely possible. It would be the same if you had mutual funds or you're investing in stocks, right? So the best way to relate it, let's say, is a stock, and a stock that's paying dividends. So theoretically, any institution, as long as you still hold those stocks and we have a history of dividends being paid to you, yes, that money can be used towards qualifying for your own personal mortgage in the future.
Okay, yeah, I just think about, trying to acquire more properties, and you're trying to say, like, look, this is where some money is coming from. And I guess, would they take that at face value, or is it similar to rental properties where they only do 50% of it or 70% of it, or, you know what I mean?
It'll vary from lender to lender. Lenders typically have a policy that they're looking for either a 2-year when it comes to variable compensation like that, they're going to look for a 2-year average, or they're going to 2-year average, most recent year, whichever is lower. But they're also going to have a restriction that basically states, depending on the lender, anywhere from 20 to 30% variance. So if, your 2018 was lower than your 2019, so right there we say, okay, we're going to be using a 2-year average. But if there is a discrepancy greater than 20 to 30%, depending on which institution you're looking to borrow from, they will tell us, well, no, you can't use an average anymore. We have to use the lower year.
Okay. Okay, so, thank you.
No problem. But sorry, the last part, Jerry, to that is if it's sitting in a registered investment or a tax-free savings account, no, we cannot use that towards qualifying because it's not actually income that you're earning today.
Okay. Yep, that's
makes sense.
Thanks, Jerry, for the question. So another question here. Sorry if I missed this part. Who can I contact for arm's length mortgages? So first, that's Diana. Diana, you want to have it set up at a institution that allows for arm's length mortgages and that's self-directed, like an Olympia or a Canadian Western Trust. And there might be a few other ones, but those are the ones we would recommend. So you can do that. Then you might want to talk to someone like Trevor who can sort of administer that for you and find someone who needs the money. Is that right, Trevor?
Yes. Yeah. Essentially, like, anybody on this call, if you've had a broker that you've dealt with in the past that, you can always reach out to them, right? You've got a relationship there already, having the conversation with them and saying, hey, you know what, looking at getting into some arm's length mortgage transactions, lending some of my money out. I'm going to transfer my money over to CWT or Olympia. Is this something that you can help me with, right? And having that conversation, obviously you've already got the trust factor there with them. Not to say that I'm not trustworthy, but if you've already got that relationship and you wanted to explore there, I've literally had calls from people where, they've got that broker already, but hey, that broker's in Hamilton or Toronto. I don't mind the risk exposure with Niagara. I predominantly am based in Niagara. I tend not to deviate from that because the reality is, I see far too often, there's a lot of Toronto brokers, not knocking them, but Toronto brokers don't know Niagara market as little as I know their market. So, having that diversification and kind of specialty that maybe if you are comfortable and looking at investments, this way, having a Niagara broker, looking at, Toronto, having a Toronto broker and kind of, diversifying and splitting things up like that.
Okay, fair enough. And then for like a typical arm's length mortgage, I know you mentioned a few times, but it's like a 7 to 9% return. Is that typical or can be expected in the marketplace?
Yeah, that's typical right now. That's what we're seeing out there. The reality is, like, we've got A lenders, first mortgages ranging anywhere from just over 2% to, I don't even want to say, 3% because they're under. We're in that 2 to 3% range right now. So we're finding all of our B lenders are hovering in and around, that I want to say 3.5 to, probably about 4.5, depending on the terms, right? Rental properties obviously have a slightly higher interest rate than principal residences. And then depending on risk, like credit and things like that, will obviously have some dictation in them. And then, so that's why, yeah, right now we're seeing, anywhere from 7 to 9 on privates.
Okay. Does TD Waterhouse also do arm's length mortgages?
They no longer do arm's length mortgages. The only investment that you can do through TD Waterhouse is a non-arm's length mortgage for yourself. So TD Waterhouse, you can do a self-directed mortgage for your own principal residence. You'd have the ability to lend yourself money and pay yourself a rate of return of whatever you desire, keeping in mind that you're the one that's paying it. So how much interest do you do have to charge yourself interest. I will clarify that. You can't not charge yourself any interest by doing so because the CRA does have a minimum requirement of 2%. But you can, minimum 2, 5, have your pick, whatever. It's your retirement.
Okay, fair enough. Now I have a question now. I'll jump in there. Let's say I'm not interested in doing mortgages, but I have this money in my, self-directed accounts, and me doing what I do, and we're doing developments now, actually in Niagara, and we're always looking for capital to feed some of these investments and bring the projects to another level, etc. What if I wanted to lend money into my own project? Now, I know technically that's not an arm's length mortgage, but what if my partner is on title and I'm on the back end as a joint venture partner? Could I technically lend into the program or to the project, lend to his corporation or lend to him so that to fuel the project?
Typically, they don't allow lending to a I'll take a step back. Depends on the type of investment. You're going to have a lot less regulation if it's a non-registered investment compared to a registered investment. So a registered investment is going to have a lot more strict lending requirements. So typically, no, you're not going to be able to do construction financing with, or at least it's going to be restricted.
So what if I'm just throwing scenarios at you here.
Yep.
What if I lent him money on a second mortgage on one of his other properties?
That was what I was going to say. If you didn't ask the question, I was going to say there's the workaround to it, where essentially it's an arm's length transaction. You could lend money on a different property. You could do theoretically an inter alia, which is a blanket mortgage across multiple properties. We don't see a lot of inter alias here in Ontario. When I worked at Scotiabank, we used to see a lot of inter alias in British Columbia. British Columbia, very, very common to blanket mortgages across 2 or 3 properties. Not as popular here, but in the event that the benefit to you by doing so is if there's not enough equity in one property, you can take multiple properties as security to better protect your investment, your asset.
Yes. And then my understanding is if I did something like that, let's say I have a partner, we'll call him John, and we're doing a development together, as long as I'm not on title on the development or anywhere, have to do anything with the corporation, I can lend to John's other property, and then he can use that money to fund the project. And I might be a sort of a silent partner with a joint venture agreement with him.
Well, essentially, you're lending him the money for whatever purpose, right? So that's your discretion, right? On an arm's length transaction, it's your discretion. You're going to look at a file and you're going to assess the overall risk. Is it something that you're willing to be involved in or not?
Yeah, the reason why I'm asking that question is because, I mean, if anybody knows me here, I deal with a lot of active, real estate investors. We're always buying and selling properties, Niagara, Hamilton, Kitchener, Brantford, Barrie, all these different places. And, people have RRSPs. I mean, that's not a secret anymore. And I think more and more people, especially in my circle, are wanting to self-direct them, but don't want to stray away from being involved in active investments. They want the kind of best of both worlds. So, and I'm in the same way. So I think people, as long as they understand that there's options for them with these little workarounds, I think it makes them feel better. They still might do, a typical mortgage investment, but knowing they can get involved in a project like this with these different workarounds, I think it helps these active investors get comfortable with the idea of doing these self-directed investments. What else is there besides mortgages that you know of or you're familiar with the self-directed accounts?
I don't know. I think we've really talked about the main piece. Like at the end of the day, in all honesty, if you're looking at, no disrespect to Olympia or CWT, but if you're looking at making a return on your investment outside of mortgages, doesn't make sense to be transferring your money there because this is what they're all about. You're better off talking to your advisor at Sun Life or IG or TD Waterhouse, Wood Gundy, all of those, right? RBC Dominion Securities. You're better off having those conversations with them if you're looking at sticking in the realm of GIC, mutual fund, stocks and bonds.
I love those guys because they all end up in my office saying their returns suck and they want to do better with me.
Yeah, sometimes, right? Sometimes that happens. Other times, again, it comes down to risk, right? It comes down to your risk of what you're willing to do. And that's really why a lot of people, look at this as an option.
Here's another question coming through. It's a good one I forgot to ask. So there's I forget the technical, the word, but the scenario is that I have an RRSP and Trevor has an RRSP. We both have $100,000 in an RRSP as self-directed accounts, and we want to free up that cash for each other. So I would put a mortgage on one of your properties, you put a mortgage on one of my properties, and I sort of get your 100 and you get my 100. Now we have 100,000 of free cash. to sort of do something else with.
Yeah, I have seen, and I see some of that going on, right? That's you're protected. You're getting your legal documents all done. In those circumstances, you don't typically involve a broker. You're sorry. This just made me think of one very, very important thing when we were talking about syndicated mortgages earlier. Legally, you are not allowed to invest in a syndicated mortgage outside of a mortgage broker. It has to be administered by a mortgage broker or a mortgage agent to be able to do so. You're not supposed, a lawyer is not supposed to be able to take a pool and put it together.
Mm-hmm. Okay.
Sorry, that sprung into my head.
No problem. No problem. So that kind of stuff's available. Okay, good. So, tell us, Trevor, like if someone has money in their RRSP, self-directed, TFSA, LIRA, and they wanted to touch base with you on a deeper level and talk about what options are available for mortgages, how do they get a hold of you? What's the process? Explain this to everyone.
Yeah, for sure. So as I said, Trevor Lindey, Neighborhood Dominion Lending Centers, telephone number 905-935-9839. Again, I'll say it, 905-935-9839. My email address is trevor@lindeyfinancial.ca. So Trevor, Trevor. Lindey is spelled Lindey. And I can see I have it in my screen there, so you can get the proper spelling that way.
When we share the recording with everybody, we'll definitely put your contact information in there so everybody can get it.
Appreciate that. Sounds good.
What's the process? Would they meet you at your office or do a Zoom call with you to go over their options? Like how do you understand people's situation?
Essentially, like I said, the KYC conversation. So the know your client, getting a better idea of your risk, what you're looking for, how much money you have to invest, and then being able to, kind of assess that situation and go from there. So always, right now I am still social distancing. I kind of feel like, Paul, you probably feel the same way. In our line of work, we could become the incubator. So I'm still trying to do my part, keeping my distance. So I am still working remotely. But yeah, those that want more than the phone call, I can always hop on a Zoom call with them and they can stare at my ugly mug while we have a chat. Cool,
man. Yeah. We're on the road like crazy. So yeah, I'm not, we're not in that boat. Unfortunately, real estate's still a physical asset. We got to be touching and knocking on doors.
Yeah, for sure.
Anyway, so let's, was there another question here?
Yeah, David asked, could you elaborate on the point of risk? I understand the notion of risk in general. In your experience, what kind of losses have you seen? So David, my personal take when I am assessing a file to determine whether or not I am going to go to a private lender, to an individual investor or not, is would I, and truly this is what I do, would I lend that person my money? If I would lend that person my money, then it's a conversation that I would have with investors. If it is not somebody that I would lend my own money to, I do have some national mix out there that deal with the entire country. They've got a lot deeper pockets. I will gladly throw, obviously because it's an opportunity to help a client, get paid on a deal. I will offer those to them, but not to individual investors. So that personally, my clients that I have, or investors, I should say, that I've lent money on their behalf, fortunately, knock on wood, hope that it still continues. Nobody has experienced any type of financial loss from it, but some losses, as I mentioned, and a big risk, because Paul and I, we were talking from construction development. That's a really good way, to kind of explain this, that if you're involved in construction financing for an individual and you are doing draws, so advances, typically mortgage financing on draws happens at, 40%, 60, 80, or 85, and 100% complete. If you're the investor and you're the one that's investing your money, and let's say that builder decides to walk away from the project, and the property is 40% complete, that's a pretty big risk from your perspective, because do you have the capital to finish, capital and or resources, trade professionals that you can call on to finish that project, so that you can recover your money. So it might end up involving a much higher carrying cost for you while you finish the project, to be able to get your money back, to be able to sell it and recover your capital.
Okay, perfect. Well, thanks for the call, Trevor. It was very informational. I hope everybody got their questions answered. Again, I'll share Trevor's information in an email along with this recording, especially for all the other people who couldn't make it. Please enjoy your long weekend. Stay safe on the waters if you're cottaging, and we'll chat in the next few weeks at our next whatever live or virtual event's going to be. Thanks, Trevor.
That sounds great. Thanks for having me to be part of it.
See you guys. Okay, recording's going to end, and we'll see you guys by email.